Hello everyone, welcome back to Finance Dean Smith. Today we're starting with the stock that absolutely stole the spotlight, Tesla. And let me tell you, this move caught a lot of people off guard. Tesla surged more than 6% in a single session. Now, if you've been following Tesla closely, you'll know this wasn't just some random bounce. What really stood out was how cleanly it played out. The stock came down, retested a key support level almost perfectly. Volume dried up to nearly nothing during that consolidation phase, and then boom, out of nowhere, buyers stepped in and pushed it higher on heavy volume. For anyone who trades technicals, this is the kind of setup you dream of. It looks almost textbook: low volume pullback, clear support test, breakout with conviction. And when you see that kind of price action from a name as big as Tesla, you can't just shrug it off. It usually means something bigger is happening beneath the surface. Now the big question is, this just a short-term rebound? Or could this be the beginning of a much larger rally? That's what traders are trying to figure out right now. And to be honest, both sides of the argument have good points. Skeptics will tell you Tesla's valuation is still sky high, that competition in the EV space is heating up, and that consumer demand might not be strong enough to justify the premium. But here's the thing: when sentiment shifts in a stock like Tesla, fundamentals don't always lead the move. Very often, it's the technical breakout that comes first, and the fundamental justification shows up later. And Tesla isn't just another stock, let's be clear about that. It's one of the most recognizable growth stories in the world. It's become a proxy for innovation, risk-taking, and frankly, the willingness of investors to chase the future. When Tesla moves, it doesn't just move by itself, it often drags sentiment for the entire growth sector with it. Let's step back for a second and remember what happened in late 2019 and early 2020. Tesla broke out in a huge way back then, and it wasn't just about selling more cars. It was about investors looking for growth opportunities in a world where interest rates were rock bottom and money was cheap. That environment allowed speculative, high-growth names like Tesla to run wild. Fast forward to today, and what are we seeing? Investors are once again betting that the Fed is going to start cutting rates soon, maybe as early as September. That changes the entire playbook. If money gets cheaper, growth stocks benefit the most, and Tesla, being the poster child for growth, is often one of the first places capital flows into when traders start positioning for that kind of shift. Now, Tesla's move didn't happen in isolation. On August 14th, U.S. time, all three of the major indexes staged a powerful rebound. The Dow Jones rallied more than 600 points, the Nasdaq climbed over 2%. The S&P 500 closed solidly higher as well. So this wasn't just a Tesla story. This was the entire U.S. equity market snapping back in unison. And when you see broad-based rallies like this, it usually tells you that something is changing in expectations. It's not just about one company's earnings report or one sector's headlines, it's about the bigger picture. And right now, that bigger picture is dominated by one narrative: the belief that the Federal Reserve is preparing to cut rates, maybe even as soon as September. Now let's unpack that. Why are markets so obsessed with rate cuts? Well, it's simple. Lower rates mean cheaper borrowing costs for businesses and consumers. It means easier financial conditions. It means higher valuations for stocks because future cash flows are discounted at lower rates. In short, it breathes oxygen back into risk assets, and that's exactly why you're seeing traders front-running the Fed right now, piling into growth names, tech, housing, and other sectors that tend to benefit when rates fall. Speaking of sectors that benefit, let's talk about real estate. One of the most interesting developments recently is Warren Buffett's move into home builders and real estate-related stocks. Now, Buffett isn't known for chasing hot trends, he's known for patience, discipline, and looking for value. So when he starts deploying billions into housing at a time when most people thought the sector was tapped out, it sends a strong signal. It tells you he sees opportunity where others see exhaustion. Buffett's bets also line up neatly with the macro story. Lower rates mean lower mortgage costs, which mean more activity in housing. It makes perfect sense that if the Fed really is getting ready to pivot, the housing market could see a second wind, and if Buffett is positioning for that, you can bet a lot of other investors are taking notice. But it's not just housing. Other areas that stand to gain include REITs, which tend to perform well when rates come down because their dividends become more attractive. Commodities could also see support as demand ramps up in a more accommodative environment, and of course fintech and other growth sectors should get a boost, because cheaper financing always helps companies that are still scaling up and burning cash. Let's also not overlook the Made in America theme, which has been gaining traction. The Biden administration has been pushing hard to bring manufacturing back to U.S. soil. We've seen this play out in semiconductors, electric vehicles, and clean energy. Now, whether or not you agree with the politics, as an investor you can't ignore the money flows. Billions in subsidies and incentives are being directed toward US-based production, and companies like Tesla are obvious beneficiaries of that. Combine that with the breakout we just saw in Tesla's stock, and you can see why the Made in America narrative is suddenly back at the center of investor conversations. Let's zoom out a little and think historically. Every time the Fed has shifted from raising rates to cutting them, the market response has been dramatic. Look at 2019, the Fed pivoted from hiking to cutting, and growth stocks absolutely exploded. Look at 2008 and the years that followed, once the Fed slashed rates and added stimulus. We kicked off a decade-long bull market that lifted just about everything. Now, obviously, no two cycles are exactly the same. But the underlying principle often repeats. When money gets cheaper, capital flows into risk assets. Tesla's breakout this week could be an early signal that investors are starting to rotate back into high-growth names ahead of that potential policy shift. So let's bring it all together. Tesla's 6% surge wasn't just about Tesla. It was about sentiment. It was about traders positioning for a macro shift. It was about the intersection of technicals, fundamentals, and policy. And it ties directly into bigger stories like Made in America, Buffett's bets on housing, and the anticipation of a September rate cut. The key question now is this: will Tesla's breakout mark the start of a sustained rally? Or will it fade as just another temporary bounce? Honestly, nobody knows for sure. But what we do know is that markets are entering a critical period. The Fed's next moves could reshape the investment landscape for the rest of the year. And Tesla, being Tesla, might just be the canary in the coal mine, the early signal of what's to come. So keep your eyes on Tesla. Keep your eyes on the Fed and watch how capital flows in the weeks ahead. Because if history is any guide, the next few months could be very, very interesting. Thanks for tuning in. This is Finance Dean Smith, and I'll see you in the next video.